Welcome back. I want to talk a little bit about today the mortgage spreads. Mortgage spread is a comparison between the 30-year average mortgage rate and the 10-year U.S. Treasury. Typically, mortgage spreads widen before or during recessions. Taking a look at the following chart, we see here the blue line represents the 30-year average mortgage that's advertised. The red line is a 10-year U.S. Treasury bond. Now, of course, the 30-year mortgage, like the 30-year Treasury bond, will typically be higher than the 10-year. The difference between the two is known as the mortgage spread. That's shown with the purple histogram bars or the histogram in the background. Now, we can see here, for example, we take a look at September 2020. The blue line, the 30-year mortgage, was significantly higher than the 10-year Treasury, and that's reflected by the purple area chart here. The mortgage spread widened. Conversely, when these two lines came rather close together, the mortgage spreads decreased. Now, the reason why this is important is because while interest rates go up and down, and that affects Treasury bonds and mortgage rates, they're not always affected the same way. During a recession or in the period coming up to a recession, banks start to get nervous. They start to require higher mortgages to protect themselves. As a result, even if the 10-year Treasury goes down, the banks will still ask for a higher mortgage, a higher percentage rate as a little bit of an insurance policy. We can see most recently that the 10-year Treasury is around 3.43%. The 30-year mortgage, the average mortgage, is about 6.27. The difference between the two, being the mortgage spread, stands at right around 3%, and that's historically a very significant level. I believe the average mortgage spread over the past several decades might be around a 1.7 level. Now, take a look at the following chart here. The yellow histogram bars represent the mortgage spread. And again, this is present day. The blue line is the 30-year mortgage. The 10-year Treasury is shown in red. And we can see that the 30-year mortgage really does not waver. It's ticking down ever so slowly. But the 10-year Treasury at the bottom is moving down at a faster rate. Now we see here the red indicates the S&P 500. The blue is the mortgage spread. And we can see here, as stocks go up, the mortgage spread tends to stay near the low. Take a look at where the mortgage spread was in 2018, 2019, 1.5%, 150 basis point difference between 30-year mortgage, 10-year U.S. Treasury. When we had that COVID crash back early 2020, stocks went down a lot. Mortgage spread catapulted higher to around 2.88%. There was a lot more risk out there. Well, we're even higher than we are now. Of course, after that stock market crash, S&P 500 made very historic highs near the 4,800 level. Mortgage spreads hit a very significant low. But notice what's peculiar is the mortgage spreads hit their low about 126 basis points on May the 19th, 2021. S&P 500 hit its high January 4th, 2022, about 7 months later, meaning that the bond market and the mortgage markets started to build in extra risk even when stocks were still going higher. See, stocks move up in anticipation of future earnings. Sometimes that has a lagging effect, and sometimes it moves in ahead of news, so to speak. But in this case, we can see here that the mortgage spread started to increase while stocks are still going up. We take a look at the following. We see here the average mortgage spreads. Go back to 2014, January. That's number one, indicates January. 158 basis point or 1.58 percentage points spread. That's the mortgage spread. February 158. The average all the way to the right, around 164. 2015, the average was 171. I believe that's a historic average. Now, we fast forward to 2020. We had that big stock market crash. The average for the whole year was 223. Notice how the mortgage spreads exploded in March, 258, 267, in April as well. 21, we had a recovery, but now we see the average so far for the year, 2023, is 2.76%. The average in April is 288. The average last month, 291. So we're very much above the historic averages for mortgage spreads. White line here shows S&P 500. The purple histogram bars show us the rate of change in 1 month. How much have mortgage spreads changed? Great example, go back to March 2020. When the stock market really dropped precipitously, the mortgage spreads exploded. They were up about 46% in a 1 month period of time. Now, they started to settle down, but then they started to increase around June 2021. June 22, we see really it's starting to accelerate higher again. And this shows us month after month, the mortgage spreads are starting to increase. And the reason why also June, July of 2022 is important is, if you remember, that's when we saw the beginning of the inverted bond yield curve between the 10-year and 1-year Treasury. That really does indicate, weakness out there and some trouble, on the horizon. So point being is that we see mortgage spreads, I should say, sitting right now with an average for the month around 288. We're just a hair below that at the moment. The average for the year is 276. It's telling us that the banks are building in an extra amount of insurance policy for themselves, because whatever factors, whatever economic numbers they're watching, they see maybe some cloudy skies on the horizon. Now, conversely, we take a look at the S&P 500 in blue, and the white line represents the VIX. The VIX is a volatility index. It's made up of the front month options and the premiums of those options on the S&P 500. It's known as the fear index. It moves up when stocks go down. So, for example, in September 2022, the S&P 500 went down to, pretty significant levels, sold off. The VIX went higher. The VIX hit a level around 34. Present day, the S&P 500's been strong, and the VIX is down near 17. 17 is a pretty significant low. We can compare the S&P 500 shown in white to the VIX, the purple histogram bars, again, at a level right now of 17. Now, the most common VIX levels are around 10, 15, 20. We can see this is the count over the past 8 years at which levels the VIX was most commonly found at. The VIX most commonly found is at the 10, 15, 20 level. So we're right in the area of complacency, meaning we're right in the area we usually expect the VIX to be, when the market has a neutral or somewhat positive tone to it. That's how we would describe the S&P 500 lately. But we can see here the average return. The average return, let's say the green histogram bar shows the average return over the next 90 days on the S&P 500. When the VIX is at the 15 to 20 level, that shows us that the S&P 500 only has an average return over the next 90 days of around 3%. When the VIX is at the 20 level, we only expect the S&P 500 to go up almost only 4% over the next 90 days or so. Conversely, when the market goes down, when the VIX goes up, we see VIX levels around 40. That's when we expect to see the next 90 days provide us with superior returns. Why? Because the market's already gone down a lot. But point being, the VIX being down here 17, we may feel a sense of complacency. We may feel comfortable. Hey, the market's going up. But because the VIX is so low, it shows us the future returns. Well, maybe we've already seen the best out there. This shows us the weekly point change in the VIX. It's been very, very quiet right now. And as a result, the 90-day return for the S&P 500, when we see a VIX with basically unchanged, which is the lowest point on this chart, is around 2%. Not very much at all. If we start to see the VIX pop up, as we see the VIX, let's say, goes up 11 points in one day, or 11 points in a close period of time, then we would expect the S&P 500 to skyrocket higher, because that indicates it already has gone down a lot. Now, fast forward to this week, again, we're at 17 on the VIX. The S&P 500, slow trend to the upside. You put these two factors together and they tell a similar story. The mortgage spread tells us that the banks out there, which really have a great idea, their finger on the pulse of the economy, a great idea about what the near-term future may hold for us, they are building in to their mortgage spreads and an extra amount of insurance, meaning they're probably a little bit nervous right now, maybe more than a little nervous. The VIX is telling us, hey, the markets are quiet. Stock market's trending higher slowly, but the data suggests that because the VIX is so quiet, that actually represents more risk as well. Now, does this mean the market's going to go down tomorrow or the next day? Absolutely not. The VIX can stay low and the S&P 500 can chug higher for a long period of time. We go to 2020, after that big stock market crash, March 2020, the purple line shows us here the VIX, came down to the 30 level, then 20, and then really for a long time, 15 to 20 in this range for quite a long period of time. And during that period of time, the white dotted line, the S&P 500, was above its 20 simple moving average, above its 90 simple moving average. It moved higher for a long period of time. These two indicators together, the VIX being so quiet and the mortgage spreads factoring in an extra amount of risk out there, is telling us stocks are going up right now, but maybe the long-term future, maybe there's some cause for concern. But we watch several different indicators, and of course, the bond markets that we discuss here on a regular basis as well. So we're going to be watching all these things. We have a pretty healthy economic calendar coming up this week as well. We hope this has been helpful. We look forward to seeing you back soon.